Are you being misled by cost segregation vendors with 100% bonus depreciation back on the table? Cost segregation studies have never been more valuable or more aggressively marketed. If you own investment property, you've probably heard the pitch, a cost segregation study will save you thousands in taxes. But what if I told you most of these companies aren't telling you the whole story, and following their advice could actually cost you more in the long run? Before you sign up for the cost seg study, let's uncover the truth behind the sales tactics, the real tax implications, and what you need to do to protect your bottom line. Let's start with what is a cost segregation study. I want you to think of it as kind of an advance on future tax deductions. So it's not necessarily creating new deductions, it's really just shifting them. Typically, when you purchase real estate, it's either residential or commercial. Residential real estate is depreciated by default over 27 and a half years, and commercial property is depreciated over 39 years. This is on a straight line basis, meaning every year it's the same amount. A cost segregation study will actually shift those deductions to front load them in the early years. And how that's done is by breaking out the different components from the property that actually have a shorter life as allowed by the IRS. You can move those components into 5-year property or 15-year property. Not only that, but by shifting them into those shorter lives, they are now eligible for bonus depreciation, which starting after January 19th, 2025 is now 100%. Since you are shifting those deductions, it's really a time value of money play, meaning you will get those deductions now with the hope that you will then reduce your tax amount. You can then use those tax savings to put that money to work, and in the future you will essentially have to pay it back in most cases. Generally, a cost segregation study is good for real estate professionals that have investments. It could also be good for business owners who own the real estate that they are operating the business out of. And it can also be good for those investing passively in real estate investments. Now I want to talk about why cost segregation sales pitches can be misleading. One main aspect is that the cost segregation companies don't have a full picture of your tax situation, which is critical in understanding whether you will benefit from the study or not. Most of the time, these cost segregation companies specialize in either only cost segregation studies, or maybe they do some other specialized studies like energy credits, the 45L or the 179D deduction, or R&D credits. They're really specialized on those areas, so they're not actually included in the tax planning that's going on with the entirety of your tax situation and what's included on your return. For that reason, they're not going to be able to assess whether you're going to get the benefits as intended or not. They're basically just looking at the property itself, doing projections on how much they think they can shift deductions into earlier years, and then they're assuming a certain tax rate. Most of the time, the people that are reaching out to you are just salespeople. They don't even understand all the implications of the cost seg studies themselves. You want to make sure you're working with someone, if you are doing a cost seg study, that actually understands the tax code and the implications of the study. Now that we've talked generally about why cost segregation companies can be misleading, let's talk about a few specifics. First of all, you have to know whether you're passive, active, or a real estate professional, because that's going to determine whether you're going to benefit from those deductions. For example, if you are a passive investor and you have a real estate property, and say it is a good candidate for a cost segregation study, but you have a full-time job, you're not active in real estate according to tax law, so you can't deduct losses against your other active income or your W-2 income. You would need other passive income to offset those deductions. Say you do a cost segregation study, you have a property, $1 million property, you do a cost segregation study, generates $150,000 in deductions this year, you have a W-2 of $400,000, and that's all you've got. Well, those deductions of $150,000, because you're not active in real estate and it's a passive activity for you, they're basically trapped. So not only can you not use those deductions, but you're out the cost of the study. Most cost segregation salespeople aren't going to tell you that. Next, you really need to understand, because it's a time value of money play, that you have to compare what is the net present value of those benefits to that cost of doing the study. So essentially, when you calculate what are my tax savings in the early years, and because you're shifting them into early years, it means you will have a higher cost in later years. You find the net present value of the change in those deductions and then compare that to the cost of the study. Which then brings me to the next point. Because it's all about shifting tax consequences, you have to compare the net present value to determine whether it's worthwhile. You really need to understand what your expectation is for how long you're going to hold on to the property. So generally speaking, holding on to the property for a lesser amount of time is going to make the study less beneficial, or maybe not beneficial at all. The longer you hold the property, the more beneficial it's going to be. Of course, there are exceptions to that rule, but I would say generally, and depending on the cost of the property, if you're not going to hold the property for at least 5 years, bare minimum, then it's probably not worth doing the study. Another consideration that needs to be taken into account is net operating losses. Net operating loss is when you have a net loss on your return, and that will carry over into future years. Why this is important is because if you create a net operating loss, the amount of the loss you can use in future years becomes limited. In the next year, you can only offset up to 80% of your taxable income. As an example, let's say that you had a $200,000 net operating loss in 2025. You go into 2026, and let's say your income was 200,000. Well, you would think, okay, well, I have a $200,000 carryover, I have 200,000 of income, so I should be at a net zero and not owe any tax. But that's not how it works. Since you're limited to offset 80% of your income, that actually means you can only use 160,000 of your carryover. This is important for cost segregation studies because you're accelerating these tax benefits. If you accelerate them to the extent that you're going to create a net operating loss, then it means that you may not be getting the benefit you expected while you're outlaying the costs.